Hello everyone. Today we will learn about profitability ratios. The profitability ratio helps the analyst measure the profitability of the company. The ratios convey how well the company is able to perform in terms of generating profits. Profitability of a company also signals the competitiveness of the management. As the profits are needed for the business expansion and to pay dividends to its shareholders, a company's profitability is an important consideration for the shareholders. We will look into the following ratios under the profitability ratio. EBITDA margin, that is called operating profit margin. PAT margin, return on equity, ROE. Return on asset, ROA. Return on capital employed, ROCE. EBITDA margin, the earnings before interest, tax, depreciation and amortization, that is called EBITDA margin. It indicates the efficiency of the management. It tells us how efficient the company's operating model is. EBITDA margin tells us how profitable the company is at an operating level. It always makes sense to compare the EBITDA margin of the company versus its competitor to get a sense of the management's efficiency in terms of managing their expense. In order to calculate the EBITDA margin, we first need to calculate the EBITDA itself. EBITDA is equal to operating revenues minus operating expense. Operating revenues is equal to total revenue minus other income. Operating expense is equal to total expense minus finance cost minus depreciation and amortization. EBITDA margin is equal to EBITDA divided by total revenue minus other incomes. Continuing the example of Amar Raja Batteries Limited, the EBITDA margin calculation for the FY14 is as follows. We first calculate EBITDA, which is computed as follows. Total revenue minus other income minus total expense minus finance cost minus depreciation and amortization. Here is a note: other income is income by virtue of investment and other non-operational activity. Including other income in EBITDA, calculation would clearly skew the data. For this reason, we have to exclude other income from total revenues. Therefore, EBITDA is 3482 minus 46 minus 2942 minus 0.7 minus 65, that is equal to 3436 minus 2876, that is equal to 560 crores. Hence, the EBITDA margin is 560 divided by 3436, that is equal to 16.3%. A financial ratio on its own conveys very little information. To make sense of it, we should either see the trend or compare it with its peers. Going with this, a 16.3% EBITDA margin conveys very little information. To make some sense of EBITDA margin, let us look at Amar Raja's EBITDA margin trend for the last 4 years. It appears that ARBL has maintained its EBITDA at an average of 15%. And in fact, on a closer look at it is clear the EBITDA margin is increasing. This is good sign as it shows consistency and efficiency in the management's operational capabilities. In 2011, the EBITDA was Rs 257 crores and in 2014, the EBITDA is 560 crores. This translates to a 4-year EBITDA CAGR growth of 21%. Please note, we have discussed the formula for CAGR in the previous videos. Clearly, it appears that both EBITDA margin and EBITDA growth are quite impressive. However, we still don't know if it is the best. In order to find out it is the best, one needs to compare these numbers with its competitors. In case of ARBL, it would be Exide Batteries Limited. I would encourage you to do the same for Exide and compare the results. PAT margin. While the EBITDA margin is calculated at the operating level, the profit after tax PAT margin is calculated at the final profitability level. At the operating level, we consider only the operating expense. However, there are other expenses such as depreciation and finance costs. which are not considered. Along with these expenses, there are tax expenses as well. When we calculate the PAT margin, all expenses are deducted from the total revenues of the company to identify the overall profitability of the company. PAT margin is equal to PAT divided by total revenues. PAT is explicitly stated in the annual report. ARBL's PAT for the FY14 is 367 crores on the overall revenues of 3482 crores. This translates to a PAT margin of 367 divided by 3482 is equal to 10.5%. Here is the PAT and PAT margin trend for ARBL. The PAT and PAT margin trend seems impressive as we can clearly see a margin expansion. The 4-year CAGR growth stands at 25.48%, which is again good. Needless to say, it always makes sense to compare ratios with its competitors. Return on equity (ROE). Return on equity is very important ratio as it helps the investor assess the return the shareholder earns for every unit of capital invested. ROE measures the entity's ability to generate profits from the shareholder's investment. In other words, ROE shows the efficiency of the company in terms of generating profits to its shareholders. Obviously, higher the ROE, the better it is for the shareholders. In fact, this is one of the key ratios that helps the investor identify investable attributes of the company. To give you a perspective, the average ROE of top Indian companies vary between 14 to 16%. I personally prefer to invest in companies that have a ROE of 18% upwards. This ratio is compared with the other companies in the same industry and is also observed over time. Also note, if the ROE is high, it means a good amount of cash is being generated by the company. Hence, need for external fund is less. Thus, a higher ROE indicates a higher level of management performance. ROE can be calculated as net profit divided by shareholders' equity into 100. There is no doubt about that ROE is an important ratio to the calculate, but like any other financial ratios, it also has a few drawbacks. To help you understand its drawbacks, consider this hypothetical example. Assume Amit runs a pizza store. To bake pizzas, Amit needs an oven which cost him at 10,000 rupees is an asset to Amit's business. He procures the oven from his own funds and seeks no external debt. At this stage, you would agree on his balance sheet. He has a shareholder equity of 10,000 and an asset equivalent to 10,000. Now, assume in his first year of operation, Amit generates a profit of 2,500. What is his ROE? This is quite simple to compute. ROE is equal to 2,500 divided by 10,000 into 100. That is equal to 25%. Now let us twist the story a bit. Amit has only 8,000 rupees. He would borrow 2,000 rupees from his father to purchase an oven worth rupees 10,000. How do you think his balance sheet would look? On the liability side, he would have shareholders' equity is equal to 8,000 rupees, debt is equal to 2,000 rupees. This makes Amit's total liability rupees 10,000. Balancing this, on the asset side, he has an asset worth rupees 10,000. Let us see how his ROE looks now. ROE is equal to 2,500 divided by 8,000 into 100. That is equal to 31.25%. With an additional debt, the ROE shot up quite significantly. Now, what if Amit had only 5,000 and borrowed the additional 5,000 from his father to buy the oven? His balance sheet would look like this. On the liability side, he would have shareholders' equity is equal to 5,000 rupees, debt is equal to 5,000 rupees. Amit's total liability is rupees 10,000. Balancing this, on the asset side, he has an asset worth rupees 10,000. Let us see how his ROE looks now. ROE is equal to 2,500 divided by 5,000 into 100. That is equal to 50%. Clearly, higher the debt Amit seeks to finance his asset, higher is the ROE. A high ROE is great, but certainly not at the cost of high debt. The problem is with a high amount of debt, running the business gets very risky as the finance cost increases drastically. For this reason, inspecting the ROE closely becomes extremely important. On way to do this by implementing a technique called the DuPont Model, also called DuPont Identity. This model was developed in 1920s by the DuPont Corporation. DuPont model breaks up the ROE formula into three components, with each part representing a certain aspect of business. The DuPont analysis uses both the P&L statement and the balance sheet for the computation. The ROE as per DuPont model can be calculated as. Let us look into the three components of the DuPont model that makes up the ROE formula. Net profit margin is equal to net profits divided by net sales into 100. This is the first part of the DuPont model and it expresses the company's ability to generate profits. This is nothing but a PAT margin we looked at earlier in this video. A lower net profit margin would indicate higher cost and increased competition. Asset turnover, net sales divided by average total asset. Asset turnover ratio is an efficiency ratio that indicates how efficiently the company is using its asset to generate revenues. Higher the ratio, it means the company is using its assets more efficiently. Lower the ratio, it would indicate management or production problems. The resulting figure is expressed as numbers of times per year. Financial leverage is equal to average total assets divided by shareholders' equity. Financial leverage helps us answer this question. For every unit of shareholder equity, how many units of asset does the company have? For example, if the financial leverage is 4, this means for every rupees 1 of equity, the company supports rupees 4 worth of assets. Higher the financial leverage along with increased amount of debt will indicate the company is highly leveraged and hence the investor should exercise caution. The resulting figure is expressed as number of times per year. As you can see, the DuPont model breaks up the ROE formula into three distinct components, with each component giving an insight into the company's operating and financial capabilities. Let us now proceed to implement the DuPont model to calculate Amar Raja's ROE for the FY14. For this, we need to calculate the values of the individual components. Net profit margin. As I mentioned earlier, this is same as the PAT margin. From our calculation earlier, we know the net profit margin for ARBL is 9.2%. Asset turnover is equal to net sales divided by average total assets. We know from the FY14 annual report, the net sales of ARBL stands at 3437 crores. The denominator has average total asset, which we know can be sourced from the balance sheet. From ARBL's balance sheet, the total asset for FY14 is 2139 crores. But think about this, the reported number is for the financial year 2014, which starts from the 1st April 2013 and closes on 31st March 2014. This implies that at the start of the financial year 2014, the company must have commenced its operation with assets that it carried forward from the previous financial year. During the financial year, the company has acquired some more assets which, when added to the previous year's asset, total to 2139 crores. Clearly, the company started the financial year with a certain rupee value of assets but closed the year with a totally different rupee value of assets. Keeping this in perspective, if I were to calculate the asset turnover ratio, which asset value should I consider for the denominator? Should I consider the asset value at the beginning of the year or the asset value at the end of the year? To avoid confusion, the practice is to take average of the asset value for the two financial years. Do remember this technique of averaging line items as we will be using this across other ratios as well. From ARBL's annual report, we know net sales is in FY14 is 3437 crores. Total assets in FY13 is 1770 crores. Total assets in FY14 is 2139 crores. Average assets is equal to 1770 plus 2139 divided by 2, that is equal to 1955. Asset turnover is equal to 3437 divided by 1955, that is 1.75 times. This means for every rupees 1 of asset deployed, the company is generating rupees 1.75 rupees in revenues. We will now calculate the last component, that is the financial leverage. Financial leverage is equal to average total assets divided by average shareholders' equity. We know the average total asset is 1955. We just need to look into the shareholders' equity. For reasons similar to taking the average assets as opposed to just current year's asset, we will consider average shareholders' equity as opposed to the current year's shareholders' equity. Shareholders' equity for FY13 is 1059 crores. Shareholders' equity for FY14 is 1362 crores. Average shareholder equity is 1211 crores. Financial leverage is equal to 1955 divided by 1211, that is equal to 1.61 times. Considering ARBL has little debt, financial leverage of 1.61 is indeed an encouraging number. The number above indicates that for every rupees 1 of equity, ARBL supports 1.61 rupees of assets. We now have all the inputs to calculate ROE for ARBL. ROE is equal to net profit margin into asset turnover into financial leverage. That is equal to 9.2% into 1.75 into 1.61. That is equal to 25.9%. Quite impressive, I must say. I understand this is a lengthy way to calculate ROE, but this is perhaps the best way, as in the process of calculating ROE, we can develop valuable insights into the business. DuPont model not only answers what the return is, but also the quality of the return. However, if you wish to do a quick ROE calculation, you can do so the following way. ROE is equal to net profits divided by average shareholders' equity. From the annual report, we know for the FY14 the PAT is 367 crores. Therefore, ROE is equal to 367 divided by 1211, that is 30.31%. Return on asset, ROA. Having understood the DuPont model, understanding the next two ratios should be simple. Return on asset evaluates the effectiveness of the entity's ability to use the assets to create profits. A well-managed entity limits investment in non-productive assets. Hence, ROA indicates the management's efficiency at deploying its assets. Needless to say, higher the ROA, the better it is. ROA is equal to net income plus interest into 1 minus tax rate divided by total average assets. From the annual report, we know net income for FY14 is 367.4 crores, and we know from the DuPont model the total average asset is 1955 crores. So, what does interest 1 minus tax rate mean? Well, think about it. The loan taken by the company is also used to finance the asset, which in turn is used to generate profits. So, in a sense, the debt holders are also part of the company. From this perspective, the interest paid out also belongs to a stakeholder of the company. Also, the company benefits in terms of paying lesser taxes when interest is paid out. This is called a tax shield. For these reasons, we need to add interest while calculating the ROA. The interest amount, that is finance cost, is rupees 7 crores. Accounting for the tax shield, it would be is equal to 7 into bracket 1 minus 32% is equal to 4.76 crores. Please note, 32% is the average tax rate. Hence, ROA would be ROA is equal to 367.4 plus 4.76 divided by 1955, that is equal to 372.6 divided by 1955, that is equal to 19.03%. Return on capital employed, ROCE. The return on capital employed indicates the profitability of the company taking into consideration the overall capital it employs. Overall capital includes both equity and debt. ROCE is equal to profit before interest and taxes divided by overall capital employed. Overall capital employed is equal to short-term debt plus long-term debt plus equity. From ARBL's annual report, we know profit before interest and taxes is equal to 537.7 crores. Therefore, overall capital employed is equal to 8.3 plus 75.9 plus 1362, that is equal to 1446.2 crores. Therefore, ROCE is equal to 537.7 divided by 1446.2, that is equal to 37.18%. In the next video, we will learn about leverage ratios. Thank you for watching this video. Please do like, comment and share this video to your friends and family members. Also, don't forget to subscribe my channel.